propagated from asset, physical asset to your financial asset, and then subsequent to entire economy, and then spillover of course happened across the asset class and across the countries. So that's why whenever we talk about portfolio, whenever we talk about type of asset, we should know what are the differences between these type of asset class. And quickly, if we take the difference between real asset and financial asset. Real asset, whatever machinery, whatever physical assets are there, they are basically part of real asset. And real asset, basically these are used for various production. If they are used for production, it means they will directly contribute to economy. This is one of the distinguishing factor whenever we talk about real asset. And these financial assets basically are created because there are real assets. For example, when a company is issuing share, so let's say here hypothetically we take that, this is the asset, physical asset company having. So these are the, you can call real asset. And company having real asset, and what company is doing, company has issued let's say debenture, or you can say that company has issued debenture. Basically, what is debenture? Debenture is debt instrument. Debt instrument. But this debenture is basically a financial asset. So what is happening? This, the person who has taken this bond or this debenture, he will get a claim on these real asset. He is not the owner of asset. What he has done, he has only purchased bond, or he has only purchased, let's say, stock. But by purchasing the financial asset issued by the company that having real asset, a claim is shared among the owner of financial asset. So what we are saying, that financial asset basically creates, give claims to the various investor or various owners in a company, and that claim is coming on claim on the real asset. In case of any, let's say, if company is not able to do well in terms of their operation, so company won't be able to pay back to their shareholder and pay back the liability towards their debt instrument or bond or debenture. So in that case, the these owner or these claimant or the people who having the are the shareholder or bondholder, they can force company for liquidation of these physical asset or real asset, and they will get their claim, or they will get proportionate claim, because when it is going to be distributed, then based on certain priority, these are going to be claims will be given to individuals. So that is the major difference between real asset. Real asset basically directly contributes in terms of production, whereas physical assets are the asset that gives claim to the asset holder, but they do not directly contribute to production. So this is a major difference. So whenever we talk about financial asset basically claim on the real asset, we can broadly classify into two categories. One category is fixed income. Fixed income means we talk about bond or debt characteristic instrument. So we call it fixed income because when we look at the characteristic of bond, when you purchase bond, you will get certain coupon or certain interest based on the stated based on the stated condition or when you purchase your bond or debt instrument. So that's why every regular every regular time period, you will have certain income, and that's why we also call these debt instrument as fixed income instrument or fixed income security. And second type of instrument is share or equity, and both will give you a kind of claim on the real asset of the issuer basically company, we are company, or sometimes these instruments are also issued by government, but because you cannot sell a real asset of government, but by default whenever government is issuing this kind of financial assets, by definition itself, we assume that government is not going to default because government having various revenue resources. So we can broadly classify, all these financial assets into three categories. First category is, your fixed income security. Second category is, your equity, and third category basically your derivatives. So by name itself, it is a derived product. So, so basically these are your derived product, your derivatives are derived product. For example, index, options and futures, you will find these are, and stock options are also there. So basically stock option, when we say, these are basically equity based product. And when we talk about other, fixed income based security, we have, interest rate swaps, interest rate swaps kind of instrument, where the, asset is something else, but instrument value is, decided based on the value of asset. So that's why we call this kind of product as derivatives. And in our course, we are definitely not going to look at, we are not going to look at our real asset. Our only focus would be the creating portfolio, considering at least these type of financial asset. Those asset will be giving a kind of claim to the owner. So other type of investment, we already know there are also investment in currency market. There are also investment in commodity market. And why people do investment in these kind of market? Generally, they go for hedging purpose. They go, especially if you go and look, oil companies, they do lots of hedging because the oil prices or crude oil prices, these their prices move a lot in a given time period. And that's why when a company, let's say company needs that, in next year I will be requiring these many gallons of oil, so they go and they go and go and sign some kind of future contract for for hedging their risk. Because if price of those crude oil or commodity goes up, then it will be a cost for the company. So that's why this is also a kind of investment, but it is not directly related to portfolio, but at high order, a portfolio we can consider. So we won't be considering this kind of hedging. I think in FRM, financial risk management, or in your derivative course, these instrument, especially related to commodity or related to hedging, will be will be dealt. But here our focus would be only on the these type of your financial asset, these kind of asset, equity, fixed income based portfolio we will be talking about. Now, whenever we talk about creating portfolio cannot be created in isolation. Portfolio will be created within the market and in a given economy. And whenever we talk about any financial market, the first thing that comes into your mind is the information. Why? Because whatever we trade in the market or the way we create our portfolio, it depends upon our assumption about the information. Because financial assets are basically the just tool to give you some kind of claim, but the value of that asset depends upon the perception about the company and how company is doing, because perception about the company depends upon how company sales are going up, what kind of product, what kind of investment company has made, and at the same time what kind of future prospect company having. And all these things, if you look at from information point of view, so basically all these are nothing but a separate set of information. One, when we look at the balance sheet, you get the book value information, and when we talk about some kind of a speculation, or when we talk about future prospect, we are also it is of course it is a kind of speculative assumption, but based on that we decide. So that's why whenever we trade any asset, the role of your information is very important. And what we generally say the price of particular stock, let's say, is the function of all the information related to the firm. But based on whether market is efficient or market is partially efficient, based on that it will be decided whether your market is really reflecting the true price or not. For example, you can we can thought of that if this is my timeline and we are you are creating portfolio in a given market, and information, let's say, came here at t is equal to 0, and initial price, if we assume p0. So if market is efficient, so what we believe that at t is equal to 1, the new updated price p1, p2, p3, and pn. So new updated price will capture the information whatever came here. But if it is not being reflected, it means your market is not functioning well, or there is some kind of delay in the information processing, and that's why it is not fully reflecting in terms of price. So even whatever portfolio you may be thinking to create, assuming that all the information is already adjusted in stock price, that may not happen. It means your entire framework of portfolio analysis, entire effort of identifying security may not function or may not be helpful. And that's why whenever we talk about portfolio, the role and the efficiency of financial market is very important. And then second point of consideration is your consumption timing. So what we are inferring from this, we are inferring because how you are going to consume. For example, when we are in early stage of our career, or when when we are around between 30 and 40s, we are less worried about retirement. Means we consume more. That's why the saving, if I convert, if I link with your your aging with saving, you will find as we are getting aged, we try to save more. And that's why the most of the saving, if you relate age group with the saving, you will find between 40 and 50, most of the people, they prefer to save, they consume less and they prefer to save. So what exactly is happening? Unless people save, it cannot be invested. Even, if you look at the mutual fund houses, if you look at the, various hedging companies, unless there is a saving, no one can invest. Even these type of financial, institution cannot function. And that's why consumption timing is another major consideration, along with the, if role of information in the given market. And then, third consideration that is, important is allocation of risk. Your financial market should ensure the proper allocation of risk. Like, when we talk about derivative product or various hedging, instrument, those instrument, what they are doing, they are trying to, minimize the risk. Or another kind of, risk, if you talk about insurance, like insurance companies are there, what they will say that, you have this type of risk. For example, you may have a risk associated with your health. So what you will be doing to with unforeseen event, because you don't know what will happen, but we generally assume that we may fall sick in coming years, so I need to buy one kind of asset. So what is happening? One way company is, your insurance company, they are getting, resource from you because you will be paying certain premium to buy insurance. At the same time, companies are getting benefit, and you are also creating a kind of, a mechanism by which, up to large extent, you are going to minimize your, risk. So what is happening? Basically, allocation of risk is taking place. And same way, whenever we talk about, mutual fund houses, whenever we talk about hedging companies, they are, doing this exercise. And it is happening because your, market is representing the true flow of information, which is reflecting in terms of the asset value. People are saving. Why? Because your market is reflecting the true value, market is efficient, and based on, and that's why people are encouraged enough to save, and they are saving. And that's why, because of, their saving behavior, allocation of resources is taking place, and it is, minimizing the risk of, individual, or risk of, parties involved. And another consideration, whenever, we talk about asset or financial asset, or, a relationship between issuer and the financial asset, is separation of ownership and management. And this is, a very debatable issue. Why I am saying debatable? For example, when we talk about a company, so here you have a company, and company, will be requiring various, resources. Various resource means basically company will be requiring capital, because if company have enough capital, they can buy machinery, real estate, basically they can create, and using that real estate, more production, and then other things can be done. So one concept that is, very much, related with, these companies is separation of ownership and management. Why? Because if we consider the very primary, company, basically, we can thought of, propriety, or, small grocery shop, where the person who is owner, he is basically, he has put his money, he has invested his money, he opened that shop, and then he is running. So basically, there is no difference between ownership and management. He is the manager, he is the owner. But think about, large companies, where, these companies require lots of capital. If company requires lots of capital, then this, same person who is owner and manager, for him or her, it would be difficult to raise capital for future, expansion and investment. So the only way it can be done is by separating the management part with the ownership. And why it is important, you think about a scenario where if owner is managing his portfolio or owner is managing his business. Basically, he is manager, he is owner. So in most of the cases, what we will observe that he won't be able to take risky projects. Why? Because all the loss that he will be making will be loss of his own. And that's why he or she would always prefer to go for suboptimal investment. Means risk may be low, at the same time the payoff or benefit from that project would be less. And that's why even from regulatory point of view, if any company wants to go to the capital market and want to raise capital, it is important a separation between the ownership and the management. The role of manager would be the creating managing the portfolio, managing various operation of the company, whereas the role of owner will be the looking at how management is functioning on the betterment, or considering their owners owner's requirement, because owner will always prefer that wealth should keep on increasing. But whether management is able to do or not, that monitoring will be done by the ownership. And most of the time, because of separation of ownership and management, one very prominent problem arises. We call it agency cost or agency problem. So what is agency problem? Because see here, if you have one owner, and owner has recruited a manager. So you have a manager. So basically manager is, we can call manager is agent of owner. So in ideal scenario, what should be done? Manager should do what owner wants. But at the same time, if manager is also trying to take care of other shareholder, because owner versus, because shareholder are also a kind of owner, as we have seen in case of previous slide, that whenever financial assets are created, these assets gives the claim. So owner along with the other shareholder, manager may want to, let's say manager may want to take two type of project. We can consider project 1 and project 2. The owner, they want that manager should go for project 2 because less risk is involved, whereas manager wants to go ahead with P1 and use this capital here. Why? Because this is more profitable. If this project is more profitable and he wants to take this, it means there is no divergence in the opinion between the manager and the owner. So this divergence in the opinion between owner and manager, we call it agency problem. And if you look at recent case, Cyrus Mistry case in Tata Group, that is a classic example of agency problem. Though your Cyrus Mistry was was one of the owner, but at the time he was there in Tata Group, he was manager. He was his role was a kind of management, and there was divergence in the opinion about whatever decision he took. Owner were not happy with that decision. So this kind of problem, we call it agency problem, and it is important because when we talk about portfolio management, at the end, managers are going to create portfolio and they will be handling on behalf of company. And unless there is a synchronization between owner and manager about investment plan, about selecting the securities for portfolio, it is not going to give the desired outcome or desired payoff. And that's why agency problem is one of the problem that must be taken care of. So what are the mechanism how this agency problem can be?
Sir,
Yeah.
sir, regarding the last slide,
Yeah.
sir, so is it that if it's a manager, then he will be able to have a tendency to take more riskier or more profitable decisions as compared to the owner? That's why the
That is that's why.
divergence
So
arises.
I have only taken one side. Chances are chances are also there where owner want that surplus should be used and manager should go and take risky project. But manager is risk averse. So it could be both way. The example, this example that I have just discussed, it just gives you a kind of clarity what is the agency problem and how it it arises. So this is basically a difference in the opinion of owner versus manager. So whenever there is non-synchronization, that problem we call it agency problem. And it costs to the company. If let's say if I observe that XYZ company management wants to do something and promoter or owner wants to do something. So in that case, the reputation of company will be distorted, especially in case of Tata Group. If you just Google it, you will find the stock prices went quite significantly down, because generally when we talk about Tata Group, we because they having long history, so we consider that Tata Group is a group that follow well established governance and ethical practice. But when we saw, when we came to know that this is what is happening and the way that issue was addressed, it really impacted the reputation of Tata as a group. And as an investor, when we let's say when you are trying to consider security which are which belongs to Tata Group, it could be Tata Steel, it could be Tata Motors. Definitely you will think about what will happen in future. If you purchase, if you include that security today in your portfolio, and that problem, agency problem, escalates, then your portfolio value may come down, right? And that's why agency problem is one of the problem that may affect security. It affect the reputation of company in and numerous dimension and number of dimensions. Yeah, and any other question?
Yes, so basically, do companies list down a set of rules which help determine how much autonomy a manager can have, or like how are these issues resolved?
Yeah, issue, see, one way is, that's why issue, these are the mechanism I was about to discuss. These are the mechanism by which agency problem up to large extent can be addressed. For example, what we can say that managers incentive, if we connect, ultimately what manager or what owner will prefer is to maximize the value of the firm. Generally, when we talk about corporate finance, we say that function of a manager is maximizing the value of firm. Value of firm. We never say that manager should maximize the wealth of the company or wealth of the firm. We say value of the firm, and when we say value, we are saying that practice, better governance, at the same time wealth creation should also take place, right? So if that is the case, so one way of avoiding is you connect success of firm with your manager's salary. You connect that if company is making profit of 100 million, 5% will be shared among top managers who are dealing those divisions or those departments. So what will happen up to large extent, manager will try to behave in a certain way that will maximize the value of the firm, or that will ensure that company may not run into losses. Another option is, you may find is we call it ESOPs, employee stock option program, or stock option program. It means what company can do, company can allocate, let's say, certain stocks. And it is happening if someone someone of you work with Google or these kind of big companies. What they do, whenever you join, what they do, they will give some kind of shares of their company. You cannot sell it. There will be certain conditions. You won't be able to sell it, but when you get share of this company, share of your company, what you will do, you will, as a manager, you will always try to maximize the value of share. It could be, you can think about n number of ways by which perception about the company or value of the stock can be maximized. So if value, because this your your holding, let's say you have n number of stock and price of each stock is PS. So basically this is nothing but the portfolio of manager, or this is the wealth of manager that company has given, company has allocated or given to the manager. So what manager will try, manager will always try to maximize the PS, or value of stock. So he may be giving quality time for analyzing the various investment option, various creating investing time in creating the best optimal portfolio for the firm, various hedging instrument he will be or she will be selecting. So this is the one way by which agency problem can be minimized up to large extent. Second option is you put a kind of monitoring. You put some kind of board of director. In every company you go and see, every company you will find board of director, and within board of director you will have independent director and dependent director. So when we talk about this, you will find independent and dependent director and dependent director. And by name itself, independent director means they are not directly linked with the company. Generally, when they sit in when they join particular meeting, their honorarium or remuneration is based on their interaction with the company. Whereas dependent are definitely they are part of company. So by establishing a board of director, they can they can monitor how entire management team is doing, and in case they find some erroneous decision, they can point it to the company, and certain measures can be taken. Otherwise, what other option is monitoring by large investor and security analyst. Why large investor? Because let's say what company has done, company has taken loan from banks, or company has taken loan from some kind of big financial institution. So if things are not moving in aligned way in a company, what generally these institutions do, or bank do, they look at how company is performing. They send their representative in their board to monitor what exactly is happening. So rather than, so second point that we just talk about here, this is the internal mechanism within the firm. And if that is also not working, then the outside investor, they can also put some kind of monitoring mechanism to ensure that the agency problem has been minimized up to large extent. And the last option is, takeover threat. So if nothing is working, but you need, some kind of control, then takeover threat. So if let's say if manager already having some kind of controlling ownership because shares were given, so what overall shareholder and your owner can do, they can take the majority of control and send manager out. So that is, we call it takeover threat. You threat your manager that if it is not going to work in this way, then we will be forced to take this kind of decision. We will have to send you out. So these are certain mechanism, but fourth one is the last option when nothing is working. Otherwise, company try to resolve agency problem by considering first and second option itself. If manager is not happy, you try to connect manager's income or salary with the performance of the firm. If that is also not working, then you need to look at how board of directors are monitoring things in the company.
Sir,
Yeah.
in case if in the first method where the manager itself has a stake in the company, in that case, don't you think that if a manager has some stake in the company, then it will induce some kind of risk aversion towards taking, like the manager in that case won't be preferring to take more riskier decisions?
Yes. Yeah, because but that's why there is a limit. There is a limit. Beyond that, ownership won't be given to the manager. Yeah, it may see, like if manager becomes owner, then the separation between management and ownership won't be there. But as per you can look at the SEBI guideline or SEC, Security Exchange Commission US guideline. You will find it clearly state that there should be separation between ownership and management. Unless that separation is mentioned in the initial document, even IPO cannot be issued. Means company cannot go to the public for raising capital. So these are certain mechanism that ensures that company will be managed effectively. Otherwise, why shareholder should come forward and invest their hard money in this company? Why they should buy shares? So to ensure that investor will be at least benefiting from their investment, these kind of setups are in place. And then of course certain guidelines exist that related to corporate governance, related to various ethical behavior. There were various accounting scandals. So like Enron, Satyam 2007, we have seen. Now every company is you will find there is also mechanism and incentive for whistleblower. So these kind of mechanisms are in place in all these companies so that agency problem and the internal governance problem can be addressed up to large extent. But this is not where we will be focusing. So but we should know there are certain guidelines. Now this is what we are more interested. We are more interested into investment and portfolio part. So whenever we create portfolio, generally these two processes are followed. First process, we call it asset allocation. So what we mean by asset allocation? This part. This is step one. Asset allocation means in market, if or in given financial market, we have a number of asset class. For example, we have equity, one class. Second class, we have debt instrument. Third broad class is derivative. So these classes we have in the market. So this is one This is second, and this is our third class. So first step is to identify the asset allocation, where exactly you want to invest. So once we decide that, of course, I would like to go ahead with the equity, it means you have done first part. And then within equity, you can have n number of choices. Right, so within equity you can have share of petroleum industry, share of FMCG. So the second step in portfolio creation is the security selection. Security selection means once you decided that your portfolio is basically going to be equity portfolio, or 50% equity and 50% debt, and then within that category you identify securities, whether it will be a Reliance share, it will be some different type of share. So but for second process you will have to do lots of calculation, like portfolio optimization, then looking at the various characteristic, risk and return profile of those securities. So this process of first asset allocation and second stage of security selection, this process of creating portfolio, we call it top-down process of investment. Top-down means first you identify what kind of asset you want for investment, and then you decide what security you want to pick from that category. So we call this approach as top-down approach of portfolio selection. So this is basically, we call it top-down approach of portfolio construction or investment process. So in most of the analysts, those who create portfolio for long run and then keep updating their portfolio, they generally follow this type of approach. They first decide what is going to be their asset allocation, and then within that category they identify securities. So this is this is what we call it top-down approach of investment process. And exactly opposite is bottom up. In bottom up, you decide your security. You decide Reliance. You decide Tata Steel. You decide other category. And then once you create your portfolio, then you see what kind of characteristic of your portfolio is, whether it is more towards equity or it is more towards your debt, and why you should know your asset class, because when you are going to compare performance of your portfolio, you are going to compare your performance of portfolio based on certain benchmark. So what why I am saying so, let's say you have created your portfolio of 10 security and all are equity. I'm assuming that you follow this. You just randomly created portfolio 10 security you have analyzed, and then that is representing your portfolio. And unless you identify your asset allocation, the first part, you cannot compare performance of your security. If you know that your entire portfolio having equity characteristic, then you need to identify benchmark. Why benchmark? Because ultimately you are going to compare how your 10 security risk and return is with compared to, let's say, Nifty 50. So Nifty 50. Or if let's say you have created all these stock belongs to bank stock, then Nifty Bank 50. Because at the end you need some proxy, some benchmark to compare. And that's why in bottom up approach, if we see, sorry, in bottom up approach, the investment is only based on the price attractiveness or security specific characteristic. Whereas in top-down approach, asset allocation is is main consideration, and then your security analysis, and that that makes your job easy. Once you decide whether you want equity portfolio or pure debt portfolio, and then or some kind of combination, because then you can easily compare your portfolio performance. And that's why most of the analysts you will find they prefer top down approach. Now coming back to certain key points that are very much tricky for investor, is first is of course risk and risk return trade-off. We assume that market is competitive, everyone is competing with each other, and in terms of knowledge, everyone having certain level of knowledge. There are also noisy trader, but in general we can assume that there are experts in the market and they are creating their portfolio, and their job itself is to create optimum portfolio. So in that competitive market, the first point that comes in our mind is related to risk and return. What kind of risk and return you are comfortable, because there are n number of assets, n number of shares, there are n number of risk and different type of risk associated with those assets. What kind of risk return profile you would prefer for your portfolio? If your risk averse, you will be happy to create a portfolio where risk is minimum or risk is very less, so that you can ensure that I'll be getting some positive return from your portfolio. But at the same time, there will be certain type of individuals who won't mind taking high risk for high performance, high return portfolio. So this is one of the major consideration. And in market, when we are competing, we are also competing to work towards getting optimal portfolio. So that's why risk return trade-off is a kind of trade-off that makes every individual's portfolio different. Because though we study same textbook, we observe, we have same set of information, but when we are going to create portfolio by nature itself, you will find your portfolio will be different from mine. Even if we all are creating portfolio purely equity based portfolio or purely debt based portfolio, and that difference is coming because of individuals' risk perception, risk preference, and risk return trade-off among them. And the second consideration is market efficiency. We know effective market represent the true price of share, or true, it immediately converts all the information and reflect in terms of asset price. But if that is the case, if market itself is very much efficient, what you will find, there is no underprice or overpriced security. So what we mean by underprice? Underpriced security is basically our security where their market value is less than their fair price or true value. It means in the future, the price of those asset or those stock will go up. So those kind of stock, we call it in case of underprice, fair value or true value, you can call true value is higher than market value. Market value means, let's say it is being traded at 100 in the market, but ideally based on the firm's fundamental value should be 120 or so. It means underpriced by 20 rupee. Same way, if fundamental fair value is, if fair value is less than market value, or market value you can say higher than fair value, it means market is stock is being traded at higher than the true value or fair value. So that kind of a stock, we call it overpriced. So if market is efficient, then you won't find under or overpricing, or mispricing won't be there. So if mispricing itself is not there, then there is no need to invest your money and your time in creating portfolio and analyzing individual security to get the best optimal portfolio. So what we will do, we will stop our discussion here. I think, yeah, few slides are there. So next session we will complete our discussion on